Hello dear students, welcome to Devika's Commerce and Management Academy. Last class, did you understand the introduction of underwriting, underwriter, commission, marked application, unmarked application? All the introduction did you follow? If yes, then we'll go for a problem. Very easy. You have to read the problem carefully, slowly, underline the important points, then we can think about the solution. Okay. Now the problem is like this. Cybertech Limited issued 1 lakh shares. Company is issuing how many shares? 1 lakh shares for public subscription, and these were, I think there is a shadow, these were underwritten by ABC. Who are the underwriters? ABC. It's underwritten by ABC in the ratio of 25%, 30%, 40%. If you add 25, 30, 45, how much it comes? 45 plus 25 comes to 70%. 70 plus 30 comes to 100. 100% underwriting. So company need not to worry. 100% underwriting given by the ABC. For how much of shares? 1 lakh shares. Did you get this point? Then we'll go ahead. Applications were received for 80,000 shares. How many applications were received? Applications we received for 80,000 shares only, not for 1 lakh. Okay. Of these applications, 16,000 stamped by A. Stamped by A, 16,000 means marked. So these are marked. Marked applications, 16,000 by A, 20,000 by B, 24,000 by C. Okay. The remaining applications did not bear any stamp, unmarked. These are marked out of 80,000 shares. We received 80,000 shares only. 80,000 subscription we have to get it. Okay. So out of this, A by 16, B by 20, C by 24,000 marked the application. Stamp is kept already. Rest of the shares not stamped, unmarked. Okay. So with work out the individual liability of underwriters. Individual liability of underwriters we have to find out. Simple, just focus 5 minutes, you'll understand. Format is this: calculation of underwriters liability. Calculation of underwriters liability. What are the columns we are writing? Particulars A, B, C, total. Particulars A, B, C, total. With pencil and scale, you have to draw the columns neatly. First, what will take? Gross liability. Gross liability means how much they have committed. 25%, 30% and 45% they have committed out of 1 lakh, right? Whatever they have committed in the initial stage, that is gross liability. 25% out of 1 lakh, it comes to 25,000. We have written. And out of 1 lakh, 30%, 3 lakh. Out of 1 lakh, 45%, it comes to 45,000. Okay, like gross liability we have written. Gross liability total is 1 lakh only. If you total up, it is 1 lakh only. When you write the gross liability, immediately you have to write the ratio of this. Ratio, if you see, generally you will get 25,000, 30,000, 40,000, 45,000 means 25 is to 30 is to 45. Right? We can simplify more. Common factor is 5 table you can do is okay. So this is 5 5s, 5 6s and 5 9s. So you got simplified ratio 5 is to 6 is to 9. Immediately you have to write 5 is to 6 is to 9. Gross liability ratio. Gross liability is this much, 25, 30, 45. How do you got 25%, 30% and 45% out of this 1 lakh rupee? So this is gross liability. Total we have written. Immediately out of this we have to deduct marked application. Marked applications is already given. Applications were received for 80,000 shares. Out of these, 60,000 stamped and 20,000 stamped, 24,000 stamped means these are all marked, already written. Marked applications we have to deduct it to get the liability. So first of all, we have taken gross liability minus marked applications. Marked applications are 16, 20, 24. So 16, 20, 24. deducted. So you got 9,000, 10,000, 21,000. Simultaneously you are doing the total also. 16 plus 20 plus 24, 60. Okay, 1 lakh minus 60, it comes to 40,000. If you want, if you add it like this also, 9,000 plus 10,000 plus 21,000 also 40,000 only, right? So we have deducted the marked application. Next we have to deduct the unmarked application. Minus unmarked application. How do you get unmarked application? Always you have to prepare working notes. So in working notes we have to mention it. So how do we get? I already told you on the introduction class. How do we get the unmarked application? That is calculation of unmarked application in working notes. For this, what we have to do? Take total applications received. How many applications we have received? 80,000 shares we have received. 80,000 minus marked is unmarked only. Total we got this much of applications. How many are marked? 16, 20, 24. 16, 20, 24 minus marked applications. So you are getting 20,000 unmarked applications. Unmarked applications minus unmarked applications. This 20,000 we have to divide between A, B and C in the same ratio. 5:6:9. That is why in the initial stage only you have to write the ratio. Okay. In this ratio you are going to distribute this 20,000. 20,000 into here 5 by 20. 5 by 20. You will get 5,000. 20,000 into 6 by 20. 6,000. 20,000 into 9 by 20. 9,000. Like I have distributed 20,000 in the ratio of 5:6:9. So this is unmarked. Unmarked we have to deduct it. Minus unmarked applications. 5,000, 6,000, 9,000. Deducted. If you deduct it, we are getting 4,000. Here also 4,000 and here 12,000. Total anyhow, if you total this 20,000, so the same 20,000. 20,000. 40,000 minus 20,000 comes to 20,000. So lastly, this is, we say it as a liability of underwriters. Liability of underwriters, how much? A is 4,000 liability is there. B is 4,000. C is 12,000. Altogether total liability is 20,000. If you want to cross check, you know that total applications received is 80,000. Out of that, so these people, they have ready to give the commitment of 60,000 only. 60,000, this total is 60,000. 80,000 minus 60,000 comes to 20,000 only. 20,000 end of the problem, we got it. In that way also you can cross check it. Are you clear? Very simple. In simple way I'll tell you. First of all, to get the individual liability of underwriter, first we have to take gross liability. Gross liability minus marked application. Marked application is always given. So if you deduct it and deduct unmarked, unmarked you have to calculate. How do you get unmarked? Simple. Applications received minus marked. Marked already given. Applications received 80,000 minus this marked. It comes to unmarked. Unmarked we have to distribute to the all the underwriters in the same ratio. Initial gross liability ratio is there. In the same ratio we have distributed. Once you distribute, the same thing you have to deduct it. Then you will be getting individual liability of the underwriter. Simple. This is the problem. Screenshot? Yes. Next problem, we'll see surplus problem. If any minus value is there, how do you work out? Very important problem. Basic problem, if you understand, that will be very easy. The same problem, if possible, without looking at the solution, you work out and see. How many of you are getting the same answer? Practice is required. If you are getting same answer, if you understood it, take out your textbook and work out more problems. You'll feel that confidence. You get a practice also. Stay connected. Check out the playlist. Whatever is required, use it, and don't forget to share these videos. Stay connected. Good luck.